From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, November 15th. You're listening to the HPS Macrocast. I'm Matt McDonald. I'm joined, as always, by John Fagan and Brendan Walsh from Markets Policy Partners. My partner, Tony Fratto, is in Las Vegas today. I have been assured that it is for client purposes, and to be honest, Tony doesn't have a lot of vices besides Pittsburgh sports, so I have every confidence that he will be back next week. In the meantime, we're here to talk about the week that was and what the state of the markets and policy looks like coming into the home stretch of the holidays. We are a short distance away from Thanksgiving and the shopping season right after that. Yeah. It feels like it's an interesting moment, despite some mixed data. It feels like the markets in general are moving towards a view of whatever kind of risk is there is more medium term than near term. But John, take us through the week that was and where we sit right now.
Yeah, thanks, Matt. This was a somewhat of a muddled week. Some mixed signals, some crosstalk, particularly on the U.S.-China trade front, and very muddy data. Although we got some more clear-cut numbers today, and Brendan will talk through those. But just to quickly dispense with the U.S.-China trade situation, obviously coming into at the end of last week, there was some question as to whether the Chinese were trying to really push the agenda here, trying to expand the scope of the Phase 1 deal. And the president really didn't seem to be on board with it. He came out last weekend and said, specifically contradicted the statements from the Ministry of Commerce spokesperson from China that they had agreed to a phased rollback of the tariffs. Now, there's a sense that this was sort of a negotiation playing out in the headlines. And this week we got, continued crosstalk, some reports that the Chinese were pushing back on the degree of agricultural purchases and some of the other tech transfer curbs that the U.S. was requesting. But there were moments of concern and doubt, but it really didn't have much of an impact on sentiment. The base case really stuck. The markets have really stuck with the base case that this Phase 1 deal is going to get done, and it's going to get done in advance of this big December 15th scheduled imposition of U.S. tariffs on Chinese consumer goods, which the White House doesn't necessarily seem all that eager to put on anyway. And so, we got some real cheerleading last night from Larry Kudlow and some positive reports also from the Chinese side that they're really trying to finalize the data today. And that, as usual, Larry Kudlow's performances are, the sort of cheerleading. He should bring a pair of pom-poms to some of these press conferences. And it really boosted the market spirits as we've seen. But it's coloring. It's improving, as Larry Kudlow is one of his favorite phrases. It's improving the mood music in markets. But when you do look at data, it has been a real mixed bag this week.
So how much? So as I look at the situation, it feels like the markets are pretty sanguine about the coming year. Like people, I don't know, as compared to earlier this year, it just feels like people are like, okay, we've got room to run. How much of what would you say is the dependency on the China trade negotiations on that attitude? If that stuff went south, like how quickly would market sentiment shift?
So kind of if you do a graph of the S&P and overlay it with the change in sentiment and how the China deal will get done or not, at the tops is when the market started to go down was because trade broke down. Yeah. Whether it was basically a year ago when this whole thing kind of started going, or the last couple of times. So I think that the markets are very correlated to this, and also going even deeper, the trade war has seeped down into the economy, especially the manufacturing sector. So it is somewhat justified, but it is kind of amazing in the last, say, 3 months. In the summertime, we were talking about recession, both people on the ground when you do Google searches, people were searching, but also professional economists. And now we've decided, okay, we're going to get a deal, but alongside that, you also had basically every central bank in the world cut rates for the last 6 months. So there is a huge amount of optimism towards this deal getting done, and maybe this deal having caused a slight manufacturing recession, which caused every central bank to ease. So now you go into 2020. Central bank easing works with a lag, so that 2020 could be off to the races a bit.
And that's why we see the market reactions like we've seen this week to the data, in which positive data tends to get a slightly, a pretty upbeat market reaction.
Right. Today, we just got the retail sales. So 2 months ago, we had huge numbers, but that was kind of slightly, it wasn't slightly, it was Amazon had their Prime Day, and everyone buys everything that. So retail sales are always going to be a lot higher then. The next month, in September, they were actually negative 0.3. People kind of freaked out about it, but they also said, well, maybe it's a mean reversion. So we just got the data today, and it actually beat expectations. So retail sales were expected to come in at 0.2 on a monthly basis, and it was 0.4. And then when you strip out autos, you kind of get like the core, like what people spend on a regular daily basis. That was a 0.4. So the consumer's still hanging in there.
I mean, this is a great point, because even as people who have been following markets closely or following some of the trade talks or macroeconomics and where all this stuff is, there's been different kind of opinions over the course of the year, and people have been following it. Consumers stayed strong all through this, and it does have this quality of, okay, coming into holiday shopping season, consumer still feels good. You have to kind of look for reasons to not get on that train, it feels like.
Yeah, sure. The reflation trade that we've talked about, in more and more investors sort of playing for, sort of feeling their way toward this 2020 first quarter, second quarter uplift. And as Brendan said, it's really about that trade détente between the U.S. and China, and a broadly more conciliatory U.S. trade posture, alongside this almost 12 months now of central bank easing in the pipeline, which should begin to kick in, finger in the wind early next year. It's quite an easy case to make. And the fact that some of the worst economic data that we've seen this year, which is out of the European Union, has stabilized. At least it's not getting, the rate of decline appears to be at least easing off a little bit. And these hints of stability are really, they're reinforcing the bias that bias, that forward-looking and more optimistic bias in the markets, and that allows investors, they're kind of inoculated to some extent against crummy numbers. So when you see lousy data, and we saw some really lousy data this week out of China.
Especially China.
Yeah, we'll talk a little bit about that in a minute. But broadly speaking, when investors in this environment, because they are casting ahead, they're looking forward to this expected rebound, they can discount some of the bad numbers that come in September, October, November, and they don't have to worry about it that much. It's too early to be disappointed about a rebound that you're expecting in first quarter of 2020 in the fourth quarter of 2019.
It's kind of a funny exercise. We've talked a lot over time about how Powell has kind of fulfilled market expectations of pause easing policy this year. It does, just as a base case, I would say the variability on market expectations versus what Trump does on trade policy is much higher.
Well, if you want to be a conspiracy theorist, so the October meeting, it was up in the air a little bit going into it, whether they were going to cut or not. And Trump kind of started playing hardball again on trade, and he got his cut. And as soon as he got his cut, it seems like we're flipping. Especially Donald is definitely in campaign mode, and he would like to put a bow on this trade deal with China and kind of run on it. But interesting.
I love long game theories on Trump's secret
I don't necessarily
genius
think
and
that
like how it's all a big whatever.
But he got what he wanted, you know. But one interesting part that worries me slightly about this deal is the president has put $50 billion of agricultural purchases very much on the table, and he's kind of talked about that on the campaign trail. But the most China's ever bought in soybeans was $24 billion. And because of the swine, the pig swine, their soy demand has been cut in half. That's basically what they use it for the pig feed. So so it's just logistically not possible for them to buy that much agricultural products.
Yeah.
And unfortunately, as of now, they don't buy meat from us because we use hormones. So unless they change that and just start buying a bunch of, chicken and pigs and everything, we just logistically can't get to 50 billion, even if China wanted to buy that much.
That number was kind of aspirational. I think
it was totally aspirational too.
I think
because 25 was the most they've ever bought, and that's a lot.
And so much of what the markets are thinking about this phase one deal is, there are going to be some parts of the deal that are like
fudged.
They're a little bit, that aren't necessarily concrete on day
over 5
one.
years.
Yeah, it's
I love it when people adjust time horizons to hit the gross number that they want to hit for the headlines. I want to talk about I want to talk about the numbers out of China. I want to talk about the Chinese economy and where that is, and in Hong Kong, and some of what we're seeing across the globe in terms of both the economics and some of the instability. But let's take a break first, and we'll come back with those hot topics in 1 second.
Markets Policy Partners provide sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com.
All right, we're back with the HPS Macrocast. This is Matt McDonald with Hamilton Place Strategies and John Fagan and Brendan Walsh with Markets Policy Partners. John, take us through the China data and what we're seeing on the ground in the economy there.
Well, we had some really key data points coming in for the month of October, and they started with, we actually saw better than expected exports. Imports were really weak, but that was the trade data really didn't look as bad as people had feared in general. So that maybe put a little rosy glow around what was happening in China that was immediately dispelled by the awful credit numbers. So over the weekend, they published total social financing and new renminbi loans. New renminbi loans are under the umbrella of total social financing, which sweeps in a bunch of different kinds of credit. And the number basically collapsed. And that was certainly not expected. The idea has basically been that the Chinese government is trying to keep the economy from slowing down too much. This is the engine of the Chinese economy is widely understood to be run, the fuel for which is credit.
Right.
And credit extension has been for years a very key indicator about future Chinese growth. And seeing it fall off the table, you don't want to overreact to 1 month, but the month before wasn't particularly good either. And this is something that if we saw repeated for the next few months would be a pretty dismal indicator for future growth. And it's not as though current growth in China is not shooting the lights out either. We just saw fixed asset investment come in, and that's measured on a year-to-date basis, and it slid to its lowest level since 1998. That's pretty poor. I mean, it's 5.2% sounds strong for us, but for China, that is not.
Yeah, I mean, the other thing that I saw recently is I think growth in Hong Kong has turned negative.
The government just forecast their first recession in a decade for this year. They expect growth to be negative 1.3% for 2019, and that's that doesn't necessarily spill over into the mainland in a meaningful way, but it certainly.
But certainly from a market's perspective, like the mainland is tied into Hong Kong financial system in a heavy way, and I have to imagine that the instability there, which. A couple of weeks back, it's protests in the street. You start looking at the images coming out now, and it's shifting from protest to violence in a fairly serious way, it feels like.
That's right, and the markets have responded this week. The intensification of the demonstrations, and this was really about daytime, workday disruptions, which had not been the norm. And schools were closed for the first time this week. They're closed through Sunday. It remains to be seen whether they're going to be reopened. There were a lot of discussions about foreign banks, particularly, but lots of other companies telling their workers to stay home. I mean, we hear from the foreign banks just because that's where we're plugged in, but I'm sure it's across the board. Telling their workers to stay home, avoid downtown areas. It's a very and of course. Rumors circulating about a curfew this weekend was very disruptive and concerning. It's It's a very difficult situation. You can obviously see it in financial markets in Hong Kong. The Hang Seng was down almost 5% this week alone. It's pretty much almost flat for the year, whereas, put that up against the 24% gain for the S&P 500. That's a dramatic underperformance. You look at options markets, they're increasing bets or hedges against a break to the downside for the Hong Kong dollar peg, which would be a huge big deal. That's certainly not anybody's base case right now, but the fact that these are showing up, these signs of stress are showing up so obviously in Hong Kong's financial markets, it speaks to just how serious investors are taking this new turn.
Yeah, and it's always tricky to kind of get a read on the ground, less so in Hong Kong, more so in China. Yeah. It's opaque. It's not an open society, so there's aspects of like getting a read on what is really happening can be difficult.
Yeah, that's true, and that's why we always, looking into the stocks and looking at at how investors are performing. They're, investors in the Hang Seng, the local benchmark equity index, are actively trying to understand the risks and price these into stocks, and so you can see it flickering through financial markets. And there'd been a sense that the protests and the Hang Seng had really rallied actually coming into this month, given the fact that there was a sense that maybe the protests had at least kind of stabilized and gotten to the point where they weren't going to get that much worse. But we certainly have seen that turn.
And in fairness, Hong Kong is not the only place in the world where there's some political instability and tricky situations on the ground. What are the markets seeing across the rest of the globe in terms of how they're evaluating the lay of the land in terms of risk on that front?
Well, Chile is obviously another serious political unrest, flashpoint for political unrest. We've seen the Chilean peso experiencing pronounced volatility and weakness against the dollar. And unlike a lot of other cases, we've seen the problems in Hong Kong. We've seen those spill over into broader sentiment in the region. And with the Chilean peso, it's a combination of sentiment and also trading dynamics. You see very often the Mexican peso being used as a proxy for less liquid Latin American countries. It's maybe not, it's kind of unfair for the Mexican peso to get dragged into some of these things, but it is that is the way it works, and it's because it's a big liquid and seen as particularly a Latin American currency proxy that you can sell more easily than you can sell a less liquid, Chilean peso.
I mean, I remember when I used to live in Boston, people would get grumpy when they raised the fares on the tea, but it was never like this. No.
Yeah, and some of the other places, obviously, that aren't necessarily affecting the mainstream investor, the protests in Beirut, the protests in Iraq, Catalonia, well, we actually have seen that. We have seen Spanish, some impact in Spanish financial markets. But it's... it's being taken. Yeah, there are the high intensity ones, and then there are the sort of low dull roar. Right. Yeah. Right. The dull roar of Brexit is still there, as with the dull roar of the impeachment hearings going on here in D.C.
Yeah. So, in fairness, the rest of the world is not the only place with political drama. Let's take another break, and we will come back and talk a little bit about what we're seeing on the ground here in D.C., what the implications are for the economy and the markets going forward.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Microsoft News Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, we're back on the HPS Macrocast. So we want to turn a little bit to the DC scene, to what's happening with
impeachment. Yes, we have political turmoil here too, right?
The Democratic primaries, which have their own heat. How are the markets looking at all these dynamics?
Yeah, well, especially with impeachment, I'm kind of amazed. Especially living down here in D.C., it's really not the main topic of conversation anymore. I mean, a part of it is it's been.
To be clear, to talk about it, you have to have a pretty deep knowledge of Ukrainian politics. Which,
I think that's part of it too.
I'm trying to bone up on, but it's not my native territory.
Exactly. So I think the market has basically it's almost slightly viewed it as a positive. So the consensus is that the House will vote to send it over to the Senate, and then there's just not the votes to
remove him.
I think we will actually. It looks like also they don't have the votes to immediately dismiss it, so we'll have to have a trial. So it's going to kind of be elongated, but the way the market is slightly viewing as a positive is while he won't be removed, I think while he has impeachment, he also has to run for office, and that kind of takes up all his bandwidth. So this helped get us a deal with China. So I think that's why the market isn't necessarily getting too freaked out when we say $50 billion or not. Like, we're getting a deal, and that's kind of the consensus with the markets.
I mean, what's weird? The other aspect is that there's been some positive signs from the House, from Speaker Nancy Pelosi on USMCA this week.
It's a great point. I was going to ask you.
It's fascinating to see in the Trump era the ability of Washington to compartmentalize these crazy, really hot fights at the top with some policy making that seems to be generally in the right direction, doing a bunch of stuff that needs to get done type of thing. I mean,
totally. And it seems like that'll probably happen because especially for the Democrats, there's a lot of congressmen that are running in, kind of red states. And you got to run on something. And they need to show that they actually came down here and did something. So I'm kind of relatively optimistic that we get a USMCA deal by the end of the year.
Yeah, it does have this quality of kind of like the crazy at the top allows people to focus on, who aren't engaged on that, allows people to focus on substance in a way, and then it actually gets on. This is not the way DC has worked in the past.
Yeah, and people aren't arguing over it, so you can actually get a normal trade agreement on this one.
Yeah. The compartmentalization is something that we also see with regards to Hong Kong. The legislation it passed the House, and now it's in the Senate, and there's now a move afoot to accelerate this pro-Hong Kong democracy bill, which has obviously drawn the ire of Beijing.
Yeah,
and to bring it to a vote,
there is concern in the markets that this could screw up the trade deal.
There's a hint of a concern in the markets that this might end up, pushing China to retaliate through the trade front and take their ball and go home from the trade table. That is certainly not the base case, and the White House has been very pretty clear about compartmentalizing the issues in Hong Kong from the trade fight. And so keeping those two separate is something that the markets will be very keen to see. And the markets are also compartmentalizing to some extent the outlook for 2020. You hear a lot of expressions of concern about the policies of some of the Democratic candidates, but that lives alongside really positive expectations for reflation, the reflationary trade and upswing in growth and in accelerating business investment. And that doesn't necessarily square with some of the rhetoric that you hear out of Wall Street. That's a lot of hand-wringing about the political scene and the anti-business and anti-rich.
Right. And it's especially driven at two candidates, Elizabeth Warren and Bernie Sanders.
Right.
So I think going back to that optimism, Warren kind of in the summer months was really ascending kind of strongly, and it was the first time that Wall Street paid attention to her. Now that she's kind of the leading candidate, she's been fading a little bit. I think people are becoming a little more optimistic that she won't be the candidate.
Yeah, it's an interesting moment. I don't think that her rollout of the $20 trillion plan to replace everybody's private health insurance went over that great from a kind of polling and momentum perspective. But the billionaires have really stepped in to give her something else to talk about. So good job, Leon Cooperman.
Yes, exactly.
It is.
That was interesting. The first person she went out with her was Bill Gates, who. So Bill's actually the one billionaire that's giving all away his money and trying to help the world. So I would have picked more one of the Wall Street.
Yeah, I mean,
so Leon helped kind of.
Yeah, and some really leading hedge fund, leading giants in the hedge fund community have come out and predicted, 25% decline in stocks if Elizabeth Warren is elected president, or even if she's the nominee.
Right.
And always these always have to be taken with a grain of salt. There's a political agenda behind these. A lot of these people are billionaires, and so they may not.
That takes talking your book to a different definition.
Favorite candidate. Of course, there were plenty of analysts and prognosticators in markets said the exact same thing about Obama and about Trump actually as well.
Especially about Trump.
There were plenty of forecasts of a dire market decline if
Trump's last
their election.
I mean, the reality of
by the morning, the Trump sell-off was over.
Yeah, the reality of the situation too. I was talking with a political operator in the UK the other week, and he was talking about the dynamics over there, and if parties switch power and stuff, and they don't have the checks that we have, so Trump just can't do anything that he wants to do, and neither could Elizabeth Warren or Bernie Sanders and all the rest of it. In the UK, they can basically do it.
But that's such an important point with like a President Warren. All the big kind of scary things that she's proposing is very much on the tax side, which requires Congress.
Yeah, there's also a dimension from a political perspective. It's always a trick to interpret what voters are actually voting for and what the will of the voters is. And there's, just because you talk about something doesn't mean that that's why people are voting for you all the time. That people are complicated, and there's a lot that goes into that. So just because you talk about anyone who's running for president talks about a range of issues. How much of a mandate you have on any one of those issues when you get into office can be ambiguous. I mean, Trump hasn't built the wall. Point. It's not it's not automatic, and you have to. There's a recalibration that happens all along the way, and people may not support some aspects, and they may support others. There may be obviously all the different constituencies that go into an election and who's voting for you. It's all very complicated.
Yeah.
Let's turn to the week ahead. We've got one more week before kind of holiday season sets in full force. What are we looking at coming up?
Yeah, so third quarter earnings season is kind of coming to the end. We've had 94% report, and so far earnings are beating by 4.4%. And it looks like EPS growth is about going to be on pace for about a 1% increase, which is pretty good, especially when we were coming in. Consensus was kind of for a slightly negative third quarter. So, that'll kind of close out the season, but we made it through third quarter earnings. It was fine. Kind of sets up for a fourth quarter rally into the year end. On the data front, we get a host of U.S. housing market data, which is always interesting, but it's not monstrously market moving. But then we get the global flash manufacturing purchasing managers index. So a company called Market does this. We'll get it's for November. So we start with Japan, then we move to Europe. Germany actually has its own one too, so people are pay close attention to that. And then we get the U.S. And then also in China, they'll have a meeting on their loan prime rate. So they kind of changed the way that they set our. We have the Fed funds rate. They have the loan prime rate. So going back to what John was saying, how things are kind of weakening in China. So there is a bit of a consensus that they might lower this.
They injected liquidity into the banking system last night, and the stimulus.
What, 200 billion yuan?
Yeah, I can't remember the exact figure, but it was appreciable, and the Chinese authorities are clearly still not in a campaign style of easing like we saw in 2016, and certainly like we saw in 2009. And so if you are, we've talked a lot about people betting on the reflation trade. If you're betting on the reflation trade for 2020, the fact that China has some real homegrown, completely apart from trade, homegrown structural headwinds on their economy has to be something that doesn't make your case all that easier for the for the trade.
But they must be. There's obviously the trade conversation is coming to a head fairly soon, so they want to see where that lands before they make a bunch of big moves, if they make big moves.
That makes sense to me.
All right, that is it for this week. Thanks, everyone, for listening to the HPS Macrocast. I'm Matt McDonald with Hamilton Place Strategies. Thanks to John Fagan and Brendan Walsh of Markets Policy Partners. Have a great weekend, everybody.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter at Tony Fratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.